You think the euro crisis ended in 2012. You remember the speech. Whatever it takes. The bond market calmed down. Italian spreads collapsed. Spanish 10 years stabilized. The story closed. The Bundesbank's balance sheet says the story never closed. Germany's central bank is currently owed more than 1 trillion euros by the rest of the Eurozone. No collateral, no maturity date, no legal procedure for collection. As of August 2025, the figure stands at 1.06 trillion euros. The crisis you think ended is sitting on a ledger almost no one reads, and it has been growing for most of the time you stopped paying attention. Here is what this video will prove. Draghi's promise compressed bond spreads. It did not resolve the underlying capital flight. The flight was absorbed by the central banking system itself, and the absorption mechanism is called target. The Bundesbank claim crossed 1 trillion euros for the first time in July 2020 and has stayed above that line for most of the period since. The European Central Bank's own bond buying program made it worse, not better. The United States Federal Reserve restructured this problem in 1975 with annual settlement. Europe never did, and the treaties that govern the euro contain no rule, none, for what happens to that 1 trillion if a member state walks away. Every reassurance you arrived with will be removed before this video ends. You were told the euro crisis ended in 2012. The Bundesbank's balance sheet says it never did. Mario Draghi stood up in London in July 2012 and said the European Central Bank would do whatever it takes to preserve the euro. Spreads collapsed within weeks. Italian 10-year yields fell from over 7% to under 5%. Headlines declared the crisis over. Here is what nobody told you. While spreads were calming on the front page, something else on the Bundesbank's balance sheet kept climbing. A claim against the rest of the Eurozone that was around 750 billion euros at the 2012 peak. By August 2025, it stood at 1.06 trillion euros. The crisis did not end. It moved. The intuitive read is that 2012 was a resolution. The operational reality is that 2012 was a relocation. Sovereign spreads compressed because the European Central Bank promised an implicit backstop. Capital that would have demanded a risk premium no longer demanded one. But the underlying funding flows, the movement of money out of Italy and Spain and into Germany, did not stop. They just stopped being priced. But the relocation went deeper than spreads. The mechanism Draghi pointed to as proof of his commitment turned out to be something the market never actually tested. The bond buying program that supposedly saved the euro was never used. Not one bond was bought. Mario Draghi's 2012 promise was backed by a specific program called outright monetary transactions. It was the technical instrument behind the famous words. It existed on paper. It was approved by the European Central Bank's governing council. It was litigated up to the German Constitutional Court. It has never been activated. Not once. 0 bonds purchased under it. Ever. The euro was rescued by the credible threat of a program, not the operation of one. The market priced the threat as if it were policy. The threat held. The program stayed in the drawer, which means the crisis was solved by a promise that was never tested, and the actual flows of money kept moving on to the central bank ledger underneath. When a flow is not priced by the market, it has to be absorbed somewhere else. The somewhere else is the Eurosystem's internal ledger. By the time the markets were quiet, the ledger was not. The cost of this section is the closure. You walked in believing 2012 was the end of a story. You leave knowing it was the moment the story was filed away in a place you weren't shown. So what is this ledger? There is a 1 trillion euro IOU inside the Eurozone. It does not appear on any country's debt to GDP chart. It is called Target, specifically Target 2, now T2. It is the payment system that settles every large cross-border euro transaction between the national central banks of the Eurozone. About 430 trillion euros in payments move through it every year. That is roughly 4 times annual world GDP, settling through one machine. Here is the part nobody talks about. When a Spanish saver moves money to a German bank account, 2 things must happen on the central bank books. Banco de España records that money leaving Spain. The Bundesbank records that money arriving in Germany. The Bundesbank is now holding a deposit it did not create. Banco de España owes that deposit back. That IOU is the target claim. The Bundesbank holds a target claim of over 1 trillion euros. Banca d'Italia holds a target liability of several hundred billion. These numbers are not in headline debt. They are not in fiscal statistics. They are not in the Maastricht criteria. They sit in central bank balance sheets, and almost nobody reads central bank balance sheets. The intuitive read is that if a 1 trillion euro problem existed inside Europe, you would have heard about it. about it. The operational reality is that the problem exists in a category of accounting that the financial press is not built to cover. Sovereign debt is in the news every day. Bank capital ratios are in the news every quarter. Central bank intrasystem claims are in the news essentially never. These claims have no maturity. They have no collateral. They have no contractual settlement date. They are recorded as assets on one national central bank's balance sheet and as liabilities on another's, and they sit there indefinitely. The Eurosystem treats them as internal bookkeeping. The Bundesbank, in its own published accounts, treats them as a real exposure to the rest of the Union. Both of those things are simultaneously true, and the gap between them is where the risk lives. The cost of this section is the assumption of complete information. You walked in believing the public statistics covered the public risk. You leave knowing there is a third ledger, larger than most national debts, that the headline numbers do not contain. The next reassurance you reach for is that this must be ancient history. Surely the imbalances peaked during the crisis years and have been winding down since. That is the opposite of what happened. ECB bond buying didn't just lower rates, it quietly moved 1 trillion euros onto Germany's books with no repayment date. Here is the mechanism. Under the asset purchase programs that started in 2015, each national central bank in the Eurozone bought mostly its own sovereigns bonds. Banca d'Italia bought Italian bonds, Banco de España bought Spanish bonds. So far, so domestic. But many of the funds and banks that sold those bonds did not bank in Italy or Spain. They banked in Germany and the Netherlands, so when Banca d'Italia bought an Italian bond from a fund whose account was at a Frankfurt bank, the cash settled at the Bundesbank. The Bundesbank's target claim went up. Banca d'Italia's target liability went up. By August 2018, the Bundesbank claim had reached around 950 billion euros, and the Bundesbank itself stated that the rise was first and foremost linked to the extensive asset purchases by the Eurosystem central banks. Quantitative easing was not just monetary policy. It was a cross-border balance transfer that nobody named. The intuitive read is that quantitative easing was a domestic monetary tool that lowered borrowing costs in each country. The operational reality is that quantitative easing was simultaneously a cross-border balance transfer mechanism because the cash from bond purchases settled in whichever country the seller's bank happened to be located in, and that country was disproportionately Germany. The legal label was monetary policy. The accounting effect was fiscal. The two were never reconciled because reconciling them would have required calling the program something other than what it was called. The cost of this section is the separation of categories. You walked in believing monetary policy and fiscal transfers were cleanly distinct activities. You leave knowing that the largest monetary policy program in European history was simultaneously the largest unacknowledged fiscal transfer in European history, and the two ran on the same wire. You might be thinking that this is just how central banking works. Internal claims accumulate. They do not really matter. Every monetary union has them. The Americans disagree. America's central bank settles internal debts every year. Europe's never does. That is why a 1 trillion euro problem keeps growing. The United States Federal Reserve has the same kind of internal claims between its 12 regional reserve banks. They are called the Interdistrict settlement account. When money flows from San Francisco to New York, it shows up as an imbalance between the regional reserve banks. Once a year in April, those positions are squared up. The regional banks reallocate securities from the system open market account to bring the imbalances back towards zero. The system has a built-in reset. The Eurozone has no equivalent. None. Target balances can grow forever, in principle, because no rule requires them to settle. There is no annual rebalancing. There is no 5-year rebalancing. There is no rebalancing. If you value calm, in-depth explanations like this, subscribe to Beneath Systems for more videos that uncover the systems shaping our world. Why the United States restructured this problem in 1975 and the Eurozone refused to in 1999 is the actual story. The intuitive read is that all currency unions accumulate internal imbalances forever, and this is just an unavoidable feature of the architecture. The operational reality is that the United States explicitly designed its monetary union not to allow this, and the Eurozone explicitly designed its monetary union to allow it without limit. The American mechanism is not exotic. risk. It is securities. Once a year, the regional Federal Reserve banks with negative positions effectively transfer assets to the regional banks with positive positions through a reallocation of the system open market account portfolio, and the books rebalance. It is bookkeeping with a deadline. The Eurozone could have copied this. It chose not to. The political economy of agreeing on what would actually transfer between Frankfurt and Rome was harder than leaving the imbalances unresolved, so they were left unresolved. Year after year, on a balance sheet that grew. The cost of this section is the assumption of inevitability. You walked in believing this is how central banking works. You leave knowing this is a design choice the Eurozone made, that the United States restructured 50 years ago, and that the choice was political rather than technical. So if the imbalances cannot accumulate forever in practice, surely there is a legal procedure for what happens if the system fragments. Surely the treaties cover the worst case. They do not. The euro has rules for deficits, bailouts, and bank failures. It has no rule for what happens to 1 trillion euros if a country leaves. The Treaty on the Functioning of the European Union runs hundreds of articles. It has explicit rules for fiscal deficits, the 3% ceiling, and the 60% debt to GDP target. It has rules for sovereign bailouts through the European Stability Mechanism. It has rules for failing banks through the Single Resolution Mechanism. It contains no procedure for settling target balances if a member state exits the euro. Because exit was politically forbidden as a topic during the treaty negotiations, no procedure for handling exit was written. The largest single contingency in the entire monetary union is the unwritten one. More than 1 trillion euros in cross-border claims, sitting inside a system that has no legal answer to the question of what happens if the system fragments. The European Central Bank insists these claims carry no risk while the union is intact. The treaties cannot tell you what happens if it is not. The intuitive read is that a monetary union of this size and importance must have rules for the worst-case scenarios. The operational reality is that the treaties are silent on the largest contingency, and the silence was deliberate. Writing the rule would have required acknowledging that exit was possible. The acknowledgement was politically forbidden, so the rule was not written. This is not an oversight. It is the architecture functioning as designed. The euro was built on the premise that exit was impossible, which meant exit could not be planned for, which meant the largest balance sheet item in the system has no exit procedure, which means if exit ever happens, the question of who owes whom 1 trillion euros will be answered by political negotiation under crisis conditions, not by legal mechanism. The cost of this section is the assumption of legal coverage. You walked in believing the treaties handled the contingencies. You leave knowing the treaties handled the contingencies that were politically permissible to discuss, and were silent on the one that was not. Now the political picture changes shape. Quiet bond markets are not proof the Eurozone healed. They are proof the risk moved somewhere markets don't look. Markets price what the European Central Bank has signaled it will defend. Since 2012, the implicit guarantee that the bank will do whatever it takes has held sovereign spreads down. Italian yields stay low. Spanish yields stay low. The market remains calm, but that calm is exactly the source of the target accumulation. The more credibly the bank defends spreads, the more capital can flow across the union without paying a risk premium, and those flows show up as target claims and liabilities. Market quiet and target growth are not opposites. They are the same phenomenon viewed from two different ledgers. One is published in the financial press every morning. The other is buried in central bank balance sheet appendices that almost nobody reads. If you are looking only at spreads, you are looking at the wrong number. For the last decade, every major European debate about whether to deepen integration has produced incremental institutional responses. Banking Union, the European Stability Mechanism, Capital Markets Union, real instruments, none of them at the scale of explicit fiscal mutualization, no common deposit insurance, no jointly issued sovereign debt at meaningful size, no federal taxing authority, no Eurobond. The political appetite was not there, so the gap was filled by something else. Headlines tracked bond spreads. The actual crisis was in a footnote on the Bundesbank's balance sheet. For more than a decade, the financial press measured the health of the Eurozone by the spread between German and Italian 10-year bond yields. When the spread narrowed, the system was calm. When the spread widened, the system was in trouble. That was the headline number. The actual structural change was happening on a different page. In the appendices of the Bundesbank's annual report, in a line item called the target claim, A number was climbing past every previous record without ever appearing on a front page. Bond spreads are a price. Prices are what markets watch. Target balances are a stock. Stocks are what nobody watches. The crisis migrated from the watched ledger to the unwatched one, which is why the people who declared it solved were not wrong about what they were looking at, just wrong about where to look. What filled the gap was the central bank ledger. Cross-border financing happened through Eurosystem balance sheets instead of through political agreement. No parliament voted for the Bundesbank to extend a €1 trillion claim against the rest of the Eurozone. No referendum was held in Germany on whether to fund Italian capital outflows. The mechanism exists, it just does not have a name on a ballot. Risk does not vanish when a crisis ends. It moves. The job is to find where. The 2008 financial crisis did not end when Lehman was wound down. It moved on to central bank balance sheets, where it has been sitting ever since. The euro crisis did not end in 2012. It moved into target balances, where it is now larger than it was at the peak of the original crisis. Sovereign debt crises do not end when bonds get refinanced. They move into the maturity profile, into the central bank's portfolio, into pension obligations that come due decades later. When the headline number calms down, that is not the moment to stop looking. That is the moment to ask which other number on which other ledger started climbing. Risk is a quantity that must be held by someone. The job is to find who is holding it now, not to celebrate that the previous holder put it down. The cost of this section is the integration narrative. You walked in believing Europe was slowly building toward fiscal union. You leave knowing Europe substituted hidden transfers for the fiscal union it could not agree to vote on, and that the substitution was successful precisely because it had no name and required no consent. The euro crisis did not end in 2012. It was relocated to the target ledger, where the Bundesbank now holds a claim against the rest of the Eurozone of more than €1 trillion, with no maturity, no collateral, and no procedure for settlement. Quantitative easing was the primary driver of the post-2015 increase because bond purchases by national central banks settled in whichever country the seller's bank was located in. The United States restructured the equivalent problem with annual settlement in 1975. The Eurozone refused to. The treaties contain no rule for what happens to these balances if a member state exits the currency. Bond markets are quiet because the European Central Bank's implicit backstop holds, and that quiet is exactly what allows the underlying flows to keep accumulating without paying a risk premium. Europe never built a fiscal union. It built a transfer mechanism no one voted for and called it accounting. For 20 years, the official story has been that European integration is gradually advancing. Banking union, capital markets union, the European stability mechanism, each step described as progress toward a real fiscal partnership. Here is the part the official story leaves out. While the explicit integration projects fell short of the political appetite needed to fund them, a different mechanism was already moving the money. The Bundesbank's target claim grew from near zero before 2008 to over €1 trillion by 2025. Cross-border financing happened. It just happened through central bank balance sheets instead of through votes. There is a name for transfers that move money from one country's balance sheet to another's without democratic approval. That name is not accounting. What does this mean for the next Eurozone crisis and for the political legitimacy of the institutions involved? The asymmetry is the point. The professionals who run the Eurosystem know this ledger exists. The Bundesbank publishes it every quarter. The European Central Bank's economists have written about it for years. The German Constitutional Court has ruled on it. None of this is secret. That gap between the people reading the balance sheet and the people reading the headlines is the structural exposure, not the trillion euros itself. The belief that the trillion euros is not there. Draghi's promise calmed the bond market. It did not close the crisis. It just moved the crisis to a place the bond market does not look. And the place it moved to has no settlement date, no collateral, no exit clause, and no name on any ballot anyone has ever voted on. The crisis you think ended is sitting on a balance sheet. The balance sheet keeps growing. Nobody has a rule for what happens next. If this video gave you a clearer way to understand the world beneath the surface, subscribe to Beneath Systems for more deep dives every week.